Accounting Academy. This is your CPA Ayman Kiwewa. In today's video, I'm going to take you through a practical question about consolidated statement of financial position, or call it balance sheet. And we are going to go step by step. Those who have been following our videos, already the steps are there. But let's try to do a complete question. The way it may appear in your examination is there. You will come across, I try to put in different scenarios which may be asked under consolidated statement of financial position or balance sheet. Let's take a look at this question. When we look at this question, we are saying the Teremo here, Teremo Limited has held shares in Dawe Limited. Now we have company A, that is Teremo, company B, that is Dawe Limited, and Somo Limited, meaning this question has 3 companies. And remember, we are on consolidated balance sheet or statement of financial position. We need to consolidate these 3 companies. Don't forget, I told you we only consolidate the parent and subsidiary. We don't consolidate associate, but rather we account for associate under IS 28, investment in associate, and we take that under our non-current asset on consolidation as investment in associate. But at this particular moment, we don't know whether it is Teremo, which is a parent, Dawe a parent, or Somo subsidiary, or it is an associate. We shall test as we move on. The following statements of financial positions were prepared for 3 companies. Now, this is what I was talking about. They're giving us 3 financial statements, financial position, statement of financial position for 3 companies as at 31st December 2023. Company 1 is Teremo Limited, company 2 is Dawe Limited, and company 3 is Somo Limited. Don't forget, we said the consolidation, we are trying to combine the financial information of a parent and those of subsidiary. Now, right now, we can't tell whether it is Teremo is a subsidiary, Dawe is a subsidiary or an associate, or it is Somo is a subsidiary or an associate. Don't worry, as we move on, we shall test and we get to know which one is a subsidiary, which one is an associate. We have been given non-current asset for company A, company B, company C, Teremo, Dawe, and Somo Limited. Current assets are there. We have been also provided with, when we check down here, we have equity and liabilities. Equity and liabilities we have here for company A, company B, and companies, that is Teremo, Dawe, and Somo Limited. Share capital, share premium, given here, share premium and retained earning for 3 companies. Current liabilities are also given. Now, we have as well been provided with additional information regarding this. You have also certain the following information. When you look at the note 1, the investment in statement financial position comprises solely Teremo Limited investment in Dawe Limited. Now, when we check on this, which investment are they talking about? Yes, it is here under non-current asset 663, and they are saying it comprises of investment in Dawe Limited and Somo Limited. We shall see that. Teremo Limited here acquired 60%. Yes, if they are saying this Teremo acquired 60% of equity shares in Dawe, meaning this one now becomes to be our parent, and this one, our Dawe, is now our subsidiary. Why is it like that? Because this Teremo is acquiring more than 50%. Don't forget, I told you when a company is acquiring shares in another company more than 50%, from 50 to 100, it qualifies to be a parent, and the acquired company qualifies to be a subsidiary. Where it is acquiring less than 50%, then it becomes an associate. Now, when you look at this, they are saying Teremo Limited acquired also 30%, meaning this company called Somo qualifies to be what? Qualifies to be an associate. Meaning now we have parent as Teremo, and we have Dawe as subsidiary, and we have Somo as associate. Now it's very clear. That should be your first step to identify who is a parent, who is a subsidiary, If there is any associate, well and good. It doesn't mean that every time they will give you subsidiary and associate. Just this example, I try to combine all. You may find you have a parent and subsidiary, or a parent, subsidiary, and associate, like for this case. Now, on note 3 here, saying when Teremo Limited acquired its shares in Dawe Limited, the fair value Limited's net asset equal to their book value, with the following exception. They are saying PPE 30 million higher. We shall see the implication. 30 million higher. Inventory is 10 million lower. Good. One is higher, one is lower. We shall see what we call fair value adjustment at that particular moment as we get on our workings. These inventories were sold during the reporting period, meaning at the end of the period, accounting period, the inventories were no more, they were sold already. So we shall see how do you account for that. You had the inventory at the beginning of the year, then at the end of the year, already the stock was sold. How do you deal with such? Saying here, when you look at note 4, depreciation on fair value adjustment to non-current assets, since this date is 15 million. Yes, we shall see that. If there is any depreciation, of course, we know depreciation reduces the value of our asset. So we shall go at the cost of this asset and we subtract our 15 million. The remaining will be reported at the end under our consolidation. And when you check on note 5, here, during the reporting period under consideration, Teremo Limited sold inventories to Dawe Limited. Now the parent, because we identified Teremo is a parent, and we already identified Dawe is a parent, a subsidiary. Now you find in this case, the parent is selling goods to the subsidiary for 180 what? 180 million, which had cost Teremo 120. This is intra-group transaction. We shall see how to deal with that. Though they are telling us 3/4 of these inventories have subsequently been sold, we shall try to look at intra-group transaction. We try to identify if there is any unrealized profit on this sold stock within the group. A goodwill impairment of 40 million. Yes, goodwill suffers impairment of 40 million. Was identified by 31st. We shall start to deal with that. And now we are saying here, note 7, it is a group policy to value non-controlling interest at full or fair value. The fair value of the non-controlling interest at acquisition was 80 million. Now they are saying here required prepare a consolidated statement of financial position for Teremo Limited Group, incorporating the associate. Remember I told you you consolidate the parent and subsidiary, but here they are telling us incorporating associate. It doesn't mean also consolidate associate, but rather it means if there is any associate, please account for it under its relevant or applicable standard, that is IS 28, investment in associate. Then you bring as investment in associate and a non-current asset. Yes, we shall do that. Hope this question is very clear. Now we are going to start. Let's start. From our previous videos, I tried to take you through the steps. We go through as we are consolidating our financial statements, more so statement of financial position. And we said step 1, we shall start by determining the group structure and acquisition date. We shall look at net asset summary. We shall try to come up with purchase consideration. If it is not given, we determine it. If it's given, well and good, we pick that. Then we shall be able to look at goodwill, if any. We shall try to look for intra-group transaction. No one will tell you that these things are there. You need to understand the concept, read the question, identify. The moment you find company A is selling goods to company B, that qualifies to be intra-group transaction. You need to do some calculations there. Then we have computation of NCI. This is non-controlling interest. We shall try to do that. Then we shall look at step 7, where we look at group retained earning. After, we need to calculate or determine investment in associate using IS 28. The moment we go through all these steps, we shall be able to start our consolidation. Consolidation whereby we shall start combining the items, that is assets, liabilities, and equity of the parent company and the subsidiary after we shall have completed our statement of financial position. This number is really very interesting and very easy. Once you move with me right from video 1 under consolidation, as we reach this step of doing the practical question, the question will become very easy. The consolidation, the group accounts will become easier for all of us, and we shall pass this number in our financial reporting. Let's start with our step 1 to determine the group structure and acquisition date. All right. We are going to start with step 1. Step 1. Step 1, determine the group structure and acquisition date. How to determine the group structure? We shall check our question. Where, remember I told you that under group consolidation, or when we are dealing with consolidated statement of financial position, we must have a parent and subsidiary or an associate, one of them. But now for this case, the first step is to identify who is the parent, who is the subsidiary, who is an associate, if any. Yes, by trying to determine that and you bring in one maybe form of structure, then comes or qualifies to be our group structure. And I always advise, if you can identify the acquisition date, it's really very important at this point to show the acquisition date. It can help you as we move on. So we have already seen here under note 1. When you check note 1 here, we are saying, is it not not 2? Teremo Limited acquired 60% of equity shares in Dawe Limited, meaning parent Teremo is acquiring 6% in Dawe and is acquiring 30% in Somo Limited. Let's try to do that. And we put under our group structure. See here, we are just going to put our group structure here. Yes, the group structure that shows the parent is showing subsidiary and is showing an associate. Now, according to this structure can show you the one who is up here, that is Teremo Limited, is acquiring shares in Dawe Limited. It is indicated by the arrows, as you can see here, and also in acquiring shares in Somo Limited. It is indicated by this arrow going down from the parent to those companies down. Let's try to determine Teremo Limited acquired how much in form of percentage. You can check on this. When you look at note 2, as here, you are saying Teremo Limited acquired 60% in Dawe Limited, and at the same time, Teremo Limited acquired 60% in Somo Limited. So if we are to go to our structure here, we have 60%, acquired 60% in Dawe Limited, and acquired 30% in Somo Limited. So where they have acquired more than 50%, this one becomes or qualifies to be a subsidiary, and where they have less than 50% qualifies to be an associate. Now, at this particular moment, we can identify who is the parent. Yes, this is our parent acquiring shares in another company. Parent, that is Teremo, acquired 60% in Dawe. Dawe qualifies to be subsidiary. Why? Because they have acquired more than 50% in that company. And for Somo, Teremo acquired less than 50%, that is 30%, qualifies to be an associate. But now another thing here, as we have 60%, we are controlling, or we are owning 60% in Dawe Limited, we have what we call NCI, non-controlling interest, the balance between 60 and 100. It is 100 minus this 60 you are controlling to make your what? Your 40%. So our NCI here is 40%. We shall see how to use that. Step 1 should always be determine the group structure and acquisition date if it is given. This structure is going to help us in the several steps before we reach the final stage of combining our financials from subsidiary and parent. Don't skip this step when you're in an examination. This step is going to guide you to help you on other steps. Without having this, without knowing who is a subsidiary, who is a parent, who is an associate, you may end up consolidating associate with parent or associate with subsidiary. Associate is not supposed to be consolidated, but rather supposed to be accounted for using a separate standard, that is IAS 28 investment in associate. Let's try to look at step 2. Let's try to look at step 2. Step 1. Let's try to look at step 2. Step 2. Step 2 is given here under our steps. Step 1 was for determining group structure. I hope we have seen you do that by determining parent, subsidiary, and associate. Step 2, determine net asset summary. Net asset summary. Let's try to do that. Determine net asset summary. Net asset summary. Now, what we need to know about net asset summary, net asset comes from where? That is from our accounting equation. You know our accounting equation. If I'm to take you through our accounting equation, we said assets equals liabilities plus what? Equity. We need to know this. Now, if we are to take this liability to the other side, we shall have assets minus liabilities. Liabilities, taking us to what? To equity. Meaning, this one, when I subtract this, I come up with what we call net asset. Meaning, our net asset equals to what? To equity. So, whenever we talk of determining net asset summary, we are referring to the components of equity. We go to the component of equity, we summarize them, we adjust them as at acquisition date and at reporting date before we consolidate in our statement of financial position. Because someone would ask, where do you find net asset? Yes, you find net asset under our equity section of the balance sheet given. Equity section. However, even in additional information, they can put some fair value adjustment because you may find they are affecting either assets or liabilities. And to get net asset, we use asset minus liability, meaning any adjustment given, we have also to adjust under our net asset summary. Let's try to do that. It is advisable, very advisable, to summarize your net assets in such a table. You just simply come with a simple table with 3 columns where you have details, you have at acquisition date and at reporting date. You go to your balance sheet under equity section. As you can see here, we're saying under equity section, yes. Pick any component of equity, say share capital, share premium, retained earning, and any components which may have been given, please bring here as at reporting date and acquisition date. At acquisition date, information regarding acquisition, you don't know it because you've been provided with balance sheet as at reporting date, meaning the information in our balance sheet will be recorded under reporting column. Then for acquisition, we shall check under additional information. If no information regarding at acquisition for a particular component of equity, we shall make an assumption that it was the same amount even at acquisition date. Let's try to go and check our balance sheet. When you go to balance sheet, yes, I said go under components of equity. We are looking at this part. And under this part, we have share capital. And share capital, this we are looking for subsidiary. We shall even look at for associate. Don't tamper with this one at this point for parent. We prepare net assets for a subsidiary. Why? We need to know the actual assets which were bought. So you don't need to prepare for parent, only for the companies you bought. Let's start with this that way, that is share capital 224, share premium 224, and retained earning 224, 344, and they are all at reporting date. Let's try to do that under our working. Saying it is share capital, share capital, share capital, it is 2, under reporting 244. Share premium still is 244. Then retained earnings, so it was 344. Yes, let's check that to confirm. 244, 244, and yes, if you have to check here, we are saying share capital, this share capital, share premium, and retained earning. Yes, one is share capital 224, 224 for share premium, and retained earning 344. Those are the figures I was picking and I was coding here. What about at acquisition? Let's try to check. If we don't have any information regarding share capital, share premium, and retained earning at acquisition date, then we shall assume the same which is at reporting, the same which is at acquisition. However, you can only get that information as you go through the additional information. Let's try to check our additional information. Our additional information regarding, yes, let's look at this note 2. It's note 2. When you look at note 2, Teremo Limited acquired 60% of equity shares in Dawe Limited when Dawe Limited is retained earnings. Retained earnings stood at how much? Retained earnings stood at 10 million, meaning the retained earning for this Dawe Limited or for this subsidiary at the date of acquisition was 10 million. When you go through this question, I'm not seeing any information regarding the share capital, share premium as at acquisition, meaning meaning we shall assume the one which is at reporting is the same information which was there at acquisition date. However, for retained earning, we have seen here it was 10 million. We take that to our table. So at the retained earning here at acquisition was 10 million. 10 million. Good. But for share capital and share premium, no information given, additional information. We take the assumption that it's still even here. It was 244. Even here, 244. You see now, we have retained earning at acquisition and retained earning at reporting date. The share capital at acquisition and share capital at reporting date, even the share premium. Thereafter, you need to look for any fair value. Fair, include fair value adjustment if given, and you incorporate it here. Fair value adjustment, the adjustment could be in regard to what? Either to asset or to liabilities, which were understated or which were overstated. However, don't assume information will be given to you under additional what? Under additional information. Let's try to go through under our additional information, see whether there is any adjustment of asset or liability. Then it can give us a guidance. Yes. When you look at note number 3, Teremo Limited acquired its shares in Dawe Limited, and at the fair value of the fair value of Dawe Limited is net asset. Remember, we are looking at net assets summary. Now they're saying the net assets equaled to their book values, which is very good. If they're equaling, no problem. The problem is to overstate the book value or understate the book value. That's why here they're giving us some exceptions, meaning we need to look at those exceptions and we adjust them accordingly, either by adding back to our net assets or by subtracting. Remember, the net assets or the assets are supposed to be recorded at book values in the balance sheet or statement of financial position. So where they are recorded at fair value, we have to adjust. Remember, fair value, that is the market value. Yet here we have to record at book value. That's why you're saying no problem. All of them were okay, equal to book value, except the following. Number one, PPE. Where do you record PPE in balance sheet? That is under non-current asset, was 30 million higher. When they say was 30 million higher, it means this someone who prepared the books or who were calculating or valuing the books or the financials of Dawe underestimated the PPE, whereby it was recorded at fair value instead of book value. And the moment you find it was PPE or any item of net asset was higher, it means that asset was understated when they were valuing at the date of acquisition. What do? We make that adjustment by adding back this 30 million because it was understated. Meaning, we shall go to our net asset summary and we add back this PPE which was understated by 30 million. Hope it's very clear. The moment you see it was the fair book value of 30 million higher, it means it was underestimated. They did not include this 30 million under PPE. It was recorded at a lower amount. That's why they are trying to bring it to your attention that though they were equal except PPE, which was higher, but for them they recorded at a lower amount. Though that statement may not be disclosed to you, what you do, just go to your net asset summary and you add this PPE or any item of, just go and you adjust it. Here you bring your PPE, it was at acquisition date, it was 30 million. We shall check what about at reporting as we move on. All right, let's look at this other item. Which item is this one? Yes, it is item of yes, inventory, also assets. Inventories. They are saying inventories. Don't forget, statement says when Teremo Limited acquired its shares in Dawe Limited, the fair value of Dawe Limited's net asset equal to their book value, which was okay, with following exception, which means even this inventory was 10 million lower. We meaning when they say lower, it means it was overstated. It was over recorded. We need to record at a lower. We need to subtract this 10 million because for them they went ahead maybe and they recorded at the market price by over. Yet the overstating. Yet the book value of this inventory was 10 million lower, less. What do? Since it was overstated in their valuations, we need to go to our net assets and we remove or we subtract this 10 million on inventories, which was overstated by then. The moment you find it is lower, go back and you subtract it. The moment you find it is higher, go back and add, meaning for lower, it was overstated, we need to go back and subtract. For higher, it was understated, we need to go back and we add. So let's take our inventories and we subtract. In other words, we shall take it as negative in our net asset summary. Yes, you bring here, you record our inventory. It was 10 million. But at the moment they say 10 million or any figure lower, we need to go and subtract. We reduce our inventory because it was overstated by recording it at market price, yet we need to record at book value. Yes. All right. What about at the reporting date here for PPE and for inventory? Let's try to look at that and see. When you check here, we are saying these inventories were sold during the reporting period ended 30th June 2015, meaning the inventory was sold. Yes, at the beginning of the year, or at the time they acquired this company, the inventory was 10, which was overset. We have to remove. However, at the end of the trading period, this stock was sold off, meaning you come here and you put your 0. It was sold. It's not that if they say balance was 2,000, we would record 2,000. 5,000. So in an examination, we can give you any figure. Maybe at the end of reporting period, the inventory had remained like 5,000, 4,000, you record. But here now they are saying at the end of reporting period, it was sold off, meaning it's 0. What about for PPE? PPE, if not sold, it can only be affected by depreciation for it to reduce. Look at note 4. When you look at your note 4, depreciation arising on fair value adjustment to non-current asset, that is our PPE, since this date was 15 million, meaning they had even depreciation of 15 million. It's very simple. So here we shall get, we can do simple working here, and we get our cost for PPE. PPE is going to be cost minus accumulated depreciation, and the cost was 30 million minus depreciation, which was 15 million, and balance is 15 million, meaning at the end of reporting period, the PPE raised as a result of fair value adjustment had remained 15 million. You bring it here, you put your 15. At the beginning or at the end, at the time when this company was acquired, the PPE raising at fair value adjustment was 30. But as we look at this depreciation, it is reducing it from where? From 30 to 15, which is very clear. When you reach that step, then you can go ahead to get for us what? The totals. Total, we are going to add net asset at acquisition and net asset at reporting what? At reporting date. When you add for me there, 244, 10,000, 30,000 minus that, we shall get, and we get, when you add there, you can get 478 million. But we are cutting zeros, that's why. Then if you are to add this one at acquisition, 244, 244, 344, 15, then there we shall come up with 807,000. Now we look at this. Net assets at acquisition was 478, at reporting was 4807, meaning there was an increase from 478 here. Let me organize it here. What the difference between from reporting? Report was 807 minus 478, which is 329, as our call this post acquisition movement, post acquisition movement or profit. Which is 329. We shall as well use this as we move on through our several steps. Hope when you look at net assets, it's really very clear. You need to determine this. Don't forget, I told you to get net asset summary. Go to equity section, pick any item or component of equity, summarize in a table by showing details. Try to show that details at acquisition date and details at reporting. After that, adjust to show total at reporting and total at acquisition. Then the difference is, if it is positive, it will be post acquisition. If it is negative, it will be loss. Now for this case, you have a post acquisition movement. Hope this step 2 is also very clear. Let's try to go to step 3. Step 3. Step 3, determine the purchase consideration. Determine the purchase consideration. Step 3, purchase consideration. Don't forget here, I'm looking at this is our subsidiary. Here you can draw for the subsidiary, and that is now our Dawe Limited. This is subsidiary. We shall even handle the asset summary for associate. All right, let's try to look at purchase consideration. Remember, I told you that purchase consideration is the amount you pay to acquire interest or shares in another company, the investment you put in another company. When you go here on note 1, when we check on our note 1, the investment in statement of financial position comprises solely Teremo Limited's investment. This investment in Dawe Limited of 473, and the one for Teremo Limited 190. They may not tell you that this is purchase consideration. Sometimes they can say maybe Teremo Limited acquired shares in K Limited and paid 400,000 million. So once someone says that it is direct, because purchase consideration can be in form of cash, can be in form of share exchange, can be in form of third payment, among other things. But you identify how much was the investment made by the parents in subsidiary or associate. For this case, it is very clear. It is 470. Even when you check in our financial statements given, investment is here showing 663,000, and here under note 1 they are showing when you add 473 plus 190, automatically you will get back the investment of 663. Yes, so 473 investment, our purchase consideration here. Yes, for Dawe Limited is 473,000. Then for Somo Limited, Somo Limited is 190 million. Purchase consideration finished. Sometimes you need to calculate. They can give you several items of purchase consideration: cash, exchange, what you add them. But now here we have for Dawe is there, and for Somo, that was the amount paid to acquire shares in Dawe Limited and shares in Somo Limited. Let's go to step 4. Step 4 was about determine goodwill. Determine goodwill. All right. Step 4, determine goodwill. Yes. Let's try to determine the goodwill. Don't forget, from our previous examples, videos, I told you, goodwill for this case is the difference between the purchase consideration, which you are seeing up there, for Dawe Limited, and the net assets acquired. Meaning we need step 2 and step 3 to determine our goodwill. However, it's still very important when you are dealing with goodwill to check the company has which policy. It is a group policy to value non-controlling interest in a full or at full or fair value. Remember, we have two methods of calculating goodwill. That is full method and proportionate share or partial method. For this case, where you see company can't have 2 or 3 policies, they will always bring one policy. Yes, this one you see it is applied when we are determining non-controlling interest. The same policy we should use when we are calculating or determining goodwill. So let's try to use this full method. When we talk of full method, we are going to incorporate the goodwill attributable to the parent and the goodwill attributable to NCI. We get total. If there is any impairment on the goodwill, we shall adjust and we get final goodwill. We shall take to our balance sheet. Let's try to do that. So we shall start with purchase consideration. and it is given up there. When if you are to check here, already we have determined Dow Limited's purchase consideration was 473. That's the money which was paid, 473. 473,000. Then we have less. We are going to subtract group share. Group share of net asset at acquisition. Acquisition. And our group share, how much are we holding in this company? How much did we buy or acquire from this company? We can get that by checking on our group structure now. That's when we see the importance of this group structure. Telemo Limited acquired 60% in Dow Limited. So our percentage for this case is 60%. You go and take your 60% there. It is 60%. 60%. Is 60% times net assets at acquisition. Remember, we determined the net assets at acquisition from our step 2. This is our net assets. You go net assets at acquisition is 478,000. Bring your 478,000. How much are you getting? We shall get 286,800. You can confirm that. We subtract that. It is yes. Now, when you subtract, when you get purchase consideration minus group share of net asset at acquisition, what do you get here? You are going to get what you call goodwill for parent or attributable to parent. That is, which is 186,200. Good. That is our goodwill. But remember, this is full goodwill. We need it to be full goodwill method. We need to determine goodwill attributable to parent and the goodwill attributable to NCI. Let's try to look the one for NCI. And when you are calculating the goodwill for NCI, we start with the fair value of NCI at acquisition will be given in the exam. How much is our fair value of NCI at acquisition? Check on this note here. They're saying it is group policy to value non-controlling interest at full or fair value method. The fair value of non-controlling interest, that is NCI, at acquisition was 80. So we shall take and we make our 80 here, which is 80,000. Even here we are going to less or subtract the NCI's share. NCI's share of net asset at acquisition. How much was it? If this was 60 for parent, it means for subsidiary is 40%. I mean for NCI is 40% times net asset, the same net asset, which is 478,000. Good. Now, when you do that, you are going to get 191,200. You need to calculate with me to confirm that. Now, this is For NCI, it was fair value of NCI at acquisition was 80. But now when you look at the net assets which were acquired, were more, that is 191 200. This is called, okay, goodwill attributable to NCI. But if you can see that it's giving us negative goodwill. It is not called negative goodwill, but rather it is called bargain purchase. You acquired more asset than the actual amount which was paid. That takes us to 200. But it is what? It is negative. Now we have two goodwill, the one for parent and one for NCI. One is positive, another one is negative. No problem. Then after that, we can determine total goodwill. Total goodwill. And we shall have, let me assume this was goodwill B, and this one is goodwill A. So I can add goodwill A plus goodwill B, that is parent and NCI. So it's going to be A plus B. Let's do that. So here it's going to be A. How much was it? You check for parent 186,200. 186,200 plus this negative goodwill. Just get minus because it is negative already. 111,200. And what is your answer here? It's going to be, when we add that, it's going to be 186,200 minus 11200. 11200, which is our 75. Our goodwill now is goodwill, total goodwill, full goodwill is 75,000. But don't forget, goodwill can be also affected by impairment. If there's any impairment which was identified, please you reduce from that point. A goodwill impairment of 40 million was identified by that date. I think there's probably this date, no problem. 2015, no problem. Was identified at the end of that trading period. We are going to subtract that impairment, that's a loss. Reductions, trying to reduce our goodwill. Remember, I told you goodwill is made up of different factors like reputation, patent, customer list, among others. If there is any decline, maybe in the brand name or what, at the end of reporting period, please, we have to reduce our impairment here. This impairment at this step. And impairment was 40 million, meaning the remaining goodwill is 35,000. 35,000. And this is the goodwill we shall take to our balance sheet as goodwill carried down as we are consolidating. Good. Hope even step 4 for determining goodwill is also finished. Let's try to look at step 5. I told you this step 5 intergroup transaction comes in if there is a purchase or sale or lending or something, but within members of the same group. Within the group, you find the parent is selling goods to subsidiary, or subsidiary is selling goods to the parent. Where you find is such, you need to do step 5, what you call intragroup transaction. Let's try to look at this. When you are to check on note, which note? Yes, note 3. Our note 3 is this. Note 3. It is not. Note 5. It is note 5. If you are to check note 5, we are saying during the reporting period under consideration, Teremo Limited, remember Teremo we have already identified is a parent, sold goods. So parent is selling goods to subsidiary, that is Dawe Limited, for 180 million, which had cost Teremo 120. 3/4 of these inventories have subsequently been sold by Dawe Limited. Let's try to check that. All right. Step 5. Step 5. Step 5 is going to be intra group transaction. Intra-group transaction. So here we are saying being the Teremo Limited, that's the parent. Teremo Limited here. Teremo Limited is selling goods to Dawe Limited. In other words, here you can even say the parent, it's the parent selling goods to who? To subsidiary. Subsidiary. Now, where you see such a scenario where a parent is selling goods to subsidiary, or subsidiary is selling goods to the parent, that qualifies to be intra-group transaction. We need to know these goods were for how much. We are saying they had cost here. If you were to look at this very well, Teremo Limited sold inventory to Dawe Limited for 180. Sales was 180 and cost 120. Good. So here we can come up with our sales. We are saying sales were equal to 180, and cost of purchases, okay, cost was 120. Of course, we know in our earlier studies, when you get sales minus cost, what do you get? You come up with gross profit. How much is now gross profit here? 60 million. That's very clear. Now, our interest is not only to know the profit, but the interest whenever you find intra-group sale or transaction in regard to sales or purchases, our interest is to identify whether those inventories which were sold within the group were sold also to outsiders. If they were sold to outsiders which are not in the group, it means the profit which was incorporated in that stock was realized. But if the stock is still within the group, like parent sold to subsidiary, and at the end of reporting period, subsidiary has not successfully sold to outsiders, it means in that inventory, it incorporates some unrealized profit, which we must identify, and we adjust it when we are consolidating. Let's look at this now. 3/4 of these inventory have subsequently been sold by Dawe Limited. If they manage to sell 3/4, what's the balance? That's a quarter. Let's try to do that. Meaning here, we have to calculate what we call unrealized profit. But before we calculate unrealized profit, we need to determine this gross profit as a percentage. Yes, there we can use margin or we can use markup. If we are to use margin to determine percentage profit margin, we shall have the gross profit over sales times 100. And our gross profit here is 60,000 over our sales, which is 180 times 100. And our percentage here, percentage profit. Remember, gross profit, the percentage of, margin is the percentage of gross profit to sales. Let's try. So it's going to be 60 Yes, it gives us 33.3%, which means the percentage profit on any sale made is 33.3%. Our interest is to determine the unrealized profit. Unrealized what? Unrealized profit. So unrealized profit, unrealized profit is calculated on closing inventory. If unrealized profit is calculated on closing inventory, means we need to determine the closing inventory. Don't forget, the question says here you have information that 3/4 of these inventories have subsequently been sold. Our interest in the closing, if they have sold the 3/4, that is, if they have managed, they are saying here not saying 3/4 have been sold, meaning the balance or what we call closing inventory is a quarter. Very clear. Meaning we can now determine the closing inventory since we know now what is the balance. They can say half of or 50% has been sold or 100%. Our interest is closing. If you don't have closing inventory, don't waste time to calculate and raise the profit. Let's try. So let's get our closing inventory. Closing inventory is going to be a quarter times the sales, which was 180. And now your closing inventory will be 45 million. Will be 45 million. 45 million. Good. I'm trying to eliminate 3 zeros. Though I'm writing 45,000, but I'm saying 45 million. Just know I'm eliminating 3 zeros. You can maintain the zeros or you can reduce 6 zeros, 3 zeros, so long as you are consistent, it will not affect your figures. Now, we can now go ahead to determine unrealized profit on our closing inventory. So our unrealized profit is going to be our percentage profit, which is 33.3 over 100 times our closing inventory, which is 45 here. And here our unrealized profit is going to be 15 million. 15 million. This is our interest. Unrealized profit will be 15 million. Now here what you need to know, since this sale was from the parent, you see from here we are saying, you look at this, it is the parent here, parent selling goods to subsidiary. So since the sales are from the parent to the subsidiary, we shall say the entire of the whole unrealized profit will be suffered by the parent or group. How will this group suffer its, or the parent suffer its what? Its loss. This unrealized profit has not realized it. So what we shall do, we shall try to use the journal entry here by debiting the parent, or what we call group retained earning by 15 million. And we shall not stop there, we shall even go and reduce our inventory because it has element of profit which will never be realized, or it is not yet realized at the end of the reporting period. So now our inventory and our balance sheet, we shall go and remove 15 million by debiting our inventory. Hope it's very clear for intra-group transaction. Start by identifying who sold the goods to who. If the members are within the group, please determine the gross profit, if any. After that, identify if there is any closing stock at the end of the reporting period. Calculate unrealized profit on it. After getting unrealized profit, then we shall be able to take this to our group retained earning as a negative by debiting group retained earning, and we credit our inventory as well to show that it is affecting what we are doing. We are trying to make adjustments, and by the time we consolidate, we don't overstate or understate our financials. Hope this step 5 for intergroup transaction is very clear. You can pause the video, try, you practice, you do on your own, and you see whether you can come up with the correct figures. Let's try to look at step 6. Step 6 is talking about NCI. Let's do that very fast, then we can move on. Step 6, non-controlling interest. This one will also form part of equity, though on a separate line. So we need to determine it at this point and we take it to our balance sheet. Our NCI, let's do it very fast. The fair value of NCI the fair value of NCI at acquisition date must be given somewhere. If you go to your question, check note 7. It is a group policy. It is a group policy to value non-controlling interest at full or fair value. The fair value of NCI at acquisition date was 80 million. Pick 8 and record it there very fast. 80 million. Then we are going to add. Let's add, if any. Let's try to add NCI's share. NCI's share. NCI's share of post-acquisition profit. Post-acquisition profit. Don't forget, our NCI was, let's check. Where did you find our NCI? That was step number. Was it step number 1? Yes. On step 1 here, it is very clear. The NCI was 40. It's here, 40%. So we're going to take 40% of post-acquisition profit. And the post-acquisition profit is here, 329,000. So let's try to do that very fast. 329. It is 40% times 329,000. 329,000. When you calculate, you can get 131,600. Good. Then we have impairment. If there is any impairment, we subtract at this point. If there is any unrealized profit, for example, if you are it was subsidiary selling goods to parent, we would share that unrealized profit. But given that it was parent selling to subsidiary, parent controls the entire transactions or entire of its transaction compared to subsidiary. Because for subsidiary it is shared by the parent and NCI. For this case, we don't have any. We are going to bring at this point. Let's get our total for NCI as our 211,600. But if we had unrealized profit, we would subtract at this point. If you have impairment, we would subtract at this point in regard to this. And the reason why I'm not, someone would ask, why are you not bringing the impairment we got under, it was under working 2 years. Impairment, you have this impairment of 40. Yes. The reason why I'm not going to bring this impairment is because the goodwill attributable to NCI, if you can see this, it was negative 111,200. So there is no goodwill for NCI. The only goodwill which was identified was attributable to the parent. That's why NCI I am not going to take. But if this was also positive, I would share the impairment for both the parent and NCI. For this case, I'm not sharing because goodwill for NCI is negative or was again purchase. That's why I've not brought it at that point. All right. Our NCI, which we shall take to balance sheet, is here 211,600. Let's look at method working 7. Let's look at working 7. Working 7, we are going to determine group retained earning. Group retained earning. Then we go. So group, we have group retained earning. For group retained earning, we are going to combine now retained earning for parent, retained earning for subsidiary, and if we have any profit from associate, we can bring it and incorporate, we add it here. Let's start. For parent, you have to go to your balance sheet and you take the one which is given. As you can see, this group retained earning at reporting date, retained earning for parent was 528. You bring that 528. Where do you get it? From the balance sheet. 528. Good. 528,000. Then you bring group share of post acquisition profit for associate subsidiary. Add group share of post acquisition profit for subsidiary, and our share was 60% times how much was our post acquisition profit. Let's check. The post acquisition profit is here. From our method 2, that was 807 minus 478, and we come up with this post acquisition acquisition profit. You pick that is 329 and you put it down. 329. So when you get your calculator there and you try to put that answer, it's giving you 197,400. Then you add the associate, we are holding only 30%. But 30% of what? Of the post acquisition profit, that is the one at reporting. When you look at retained earning for this associate, retained earning, it was 290. Which is this one, 290 minus the one at acquisition. How much was it? Acquisition date, yes, check here. shares in Somo Limited when that company had a retained earning balance of 260, meaning here it is 260. How much is it? When try to calculate, you're going to get something like 9,000. 9,000. Then from there we can less. Yes, we start by subtracting impairment here. Impairment here. But impairment was how much? When you go to the question, even from our workings, they're saying here, impairment, which note was that? When we check our impairment, yes, not 6. Goodwill impairment affects our retained earnings. So we shall bring and we subtract our 40,000 here. 40,000. And after that, we less group share of unrealized profit, that is, it was 15,000. 15,000. If you want to see this, the 15,000 is here. We calculated it already. And unrealized profit. And we said we shall debit group retained earning and we credit inventory. That's why we are under group retained earning working and we are debiting or we are subtracting the 15,000, which is unrealized what? Unrealized profit. So when you finish this, you can get our total. You can get your total or what you call retained earning or group retained earnings. Group retained earning. How much is it? You can add. When you add the group retained earning for parent, group share of post-acquisition profit for subsidiary, add group share of post-acquisition profit for associate, less impairment, less group share of unrealized profit, the balance will be 6. It will be 6, 7, 9, 400. Good. Hope we okay with group retained earning. Please, you have to get the one for parent, share of parent for subsidiary, share of parent for or group for associate. If there's any impairment, you subtract it. If there is any, and it was profit for this case, you subtract, and what you remain with is the group retained earning. And this is the group retained earning we shall take to our balance sheet or consolidated balance sheet. Let's go to last working and we consolidate our number. Last working is 8, investment in associate. Remember they told us, please incorporate the associate. Incorporate the associate. So we're going to incorporate at this step 8, investment in associate. Let's try to do it. For investment in associate, we shall account for it using equity method, that is under IS 28, where we get the initial investment, we add the post-acquisition profit, and finally we shall be able to come up with our investment in associate. We shall put in this in our balance sheet or consolidated statement of financial position. Investment in associate here, you can find it here under purchase consideration. How much do you pay? Here is saying the investment in statement of financial position comprises for Teremo Limited 473 and for Somo Limited 190. Don't forget our associate here. Our associate is what? Our associate is Somo Limited. So here we have 190 initial investment, 190. Then post acquisition profit, the share, that is the share of this our share in associate, it was only 30%. Yes, 30% times post acquisition profit. We saw it here, post acquisition profit in associate here. post-acquisition profit, you can check it was 30% times 290. This minus this, the post-acquisition profit was 9,000. You can take 9,000. When you add, you can get with investment and associate as 199,000. Yes, 199,000. Finished. Now you can look here. When you check on our steps as you're consolidating, we started with determine group structure. We have done that. Determine the net asset summary. We have determined the purchase consideration, goodwill, intra-group transaction, computation of NCI, group retained earning, and investment in associate. After completing this, now you can go ahead and consolidate by putting the format for balance sheet, and we pick our items. Let's try to do that. Let's try. Now, having completed doing our workings from step 1 up to step 8, where we have investment on associate, we are now going to be able to answer our question. The question was prepare a consolidated statement of financial position. When they ask you to prepare a consolidated statement of financial position, it means let's try to present using the right format. Let's put the format for balance sheet. We include the assets, the liabilities, equity, after adjusting the way we have done. Let's start by taking this format. Yes, the format is very clear. It shows Telemo Limited is group, Telemo Limited group statement of financial position, balance sheet, as at 31st December 2023. Details, column 1, column 2, those are just the units for, symbol for dollar. Let's start. We are going to use the question which is given, this one. We are going to use this. Remember, don't forget, I told you as we are consolidating, we are only concentrating on parent and subsidiary. This one of associate, don't consolidate it. You leave it aside. We are only adding items of parent, that is Telemo, and items of subsidiary, that is Dawe. For Somo Limited, that is our subsidiary, we shall only bring investment in subsidiary and non-current asset. Let's start. Non-current asset, let's try to follow this format you are seeing here as we are consolidating. Non-current asset, you pick it and click here. Non-current asset. Non-current asset. And non-current asset, we have PPE. And PPE, let's try to add this. There is this one, PPE 282 plus 202. Don't forget, we are not adding for Somo Limited. We are only adding parent Telemo and Dawe. 228 and 202. We shall take our PPE is 282,000. We add 202,000, and we are going to add our fair value adjustment. We had that step 2 for PPE. It was 15,000. You bring it at 7. Here it's not there. It is PPE 282,000 plus 202,000. We are adding the fair value of PPE, the PPE which was understated, and we calculated even depreciation at the end of the reporting period. The assets value had reduced because of depreciation from 30,000 to 15,000. We did that working. You go there, you pick the figure, and you bring at this point. Then you get your total PPE as 499,000. Good. We calculated goodwill. If you remember, that was working for. goodwill. When we check here, goodwill is not under our non-current asset there, but as a result of consolidating and our working for, we determine the goodwill. You bring it at this point, which was 35,000. Then there is step 8. You remember we calculated this step 8, which was investment in associate, and we got it was investment in associate, investment in associate, investment in associate. It was 1. Our last working, go and check there, 199,000. So you find under non-current asset, we have added other items like like goodwill as calculated under note 4. We calculated investment in associate as our last working. After that, you add to get total non-current asset. Just add, and when you add, you will get your total there. Let me try here as you are also adding that side. It is 499 plus 35 plus 199, which is 773. 773,000. Good. Let's bring current asset. Our current asset, and under current asset, still go back to your balance sheet you given. We have inventory, trade receivables, and the cash. Remember, we are taking for only Telemo Limited and Dawei Limited, the parent and the subsidiary. So we are going to add 370 plus 190. Don't add 60. We are only adding this plus this. Don't include this one. This is an associate. We don't consolidate or we don't add on our financials. We are only adding inventory for parent and subsidiary, trade receivable for parent and subsidiary, and cash the same way. Do the same way. All right, let's start. Number 1 is inventory. Inventory it was 370 plus 190. 190 it is here. Inventory is 370 plus 190. But here we are going to subtract unrealized profit. We calculated the under group transaction, which was 15,000. At this step, that's where you calculate unrealized profit and you bring. Remember, under our unrealized profit, we said it affects group retained earning and even it affects our inventory. By debiting inventory, we subtract it to reduce its value. How much do you get there? You get something like 55,000. Then we have trade receivables. Trade receivables, see there. Trade receivables, it is 180 under current asset plus 200,000. 180 plus 200 what? 200,000. And you get 380. 380. 380. Good. Another item there we are consolidating is cash. Parent has 133 and Dawei Limited subsidiary has 404. We shall get cash, and under cash we have 133,000 plus 404, and our final answer will be 537,000. Let's try to get total current asset. Total current asset, we shall add 545 plus 380 plus 537, which is 146 146,2 is 1,462,000. Now, if we are to get our total assets here, if we are to get total assets, it's going to be, we shall add non-current asset plus non-current asset, which is 733 plus 1,462,000, which is 1 million. Shall get 1 million. Sorry, it is 2,195. 2,195. Giving us 2,195,000. Don't forget our balance sheet, we prepare it using accounting equation assets equals to liabilities plus equity. So the part of our asset, current asset and non-current, gives us our 2,195,000, as you can see here. Let's look at the part for equity. For the side of equity and liabilities, remember it has to balance with total assets on the other side. We expect to get 2,195,000 from equity plus liabilities as well. We shall start with share capital. And the share capital you need to start with here is the one which is given for parent in the balance sheet given, financial statements given. So we are going to take share capital of parent, share premium of parent, and I'm talking about this. We are taking this figure, we're taking this one, and when it comes to this one, we don't take this one, but rather we shall take the consolidated one for group retained earning. So here for share capital, let's take 360 for group, share premium 280 for group, retained earning, we shall take the group retained earning. Here don't add, this is not allowed to add the one for share capital and the share capital for parent and subsidiary. This point we don't add, rather we take only for parent. After for group retained earning, we get it from our working. Let's try to do that. The share capital 360 for parent, we take that one. Share capital is 360. Good. 360. Then we have share premium. Share premium, yes, 280. Then group retained earning. Group retained earning. Group retained earning. Group retained earning, we calculated it from the group. It was 679 400. It was under working. You can even verify working. It was working 8, working 7. You can go reflect, check working 7. You will get that group retained earning. Here, when you reach this step, you skip one line and you bring NCI. Our NCI, this was working, I think working 7. You can go back and check NCI, which was 2 1 2 1 1 600. Don't forget, for equity section, I have picked only share capital for parent, share premium for parent. But when I reach retained earning, I didn't take this one, 528. No, you go to your working 7, pick group retained earning you calculated, then you take that. Then you bring even NCI. Here we don't have NCI, but here you have also to include to form part of equity. After that, you can as well get total equity here, and you put it the other side. So it's going to be 360 plus 280 plus 679.4, which is going to be 1,319,400. What left here now, we are done with equity. What left is current liability, and we finish our number. Current liability. The liability, current liabilities. It's going to be current liability. Check here. We have trade payables. Current liabilities here. And account we have trade payables. And under trade payables, we have down here, we have trade payables here. We are taking this one 460 for parent and 204 for subsidiary. You just add them. We are consolidating by adding these figures together for parent and subsidiary. So we shall get our 460 plus the 204,000. When you add, we shall get our 664. We shall get, when you add trade payables 460 plus 204, we shall get our 664,000. You need to go back to the question to check whether you have not left any item. You have seen how we have included the non-current asset, current asset, equity, current liability. If you have long-term liabilities, still you have to consolidate. But don't forget, as we are consolidating, we are adding financials of parent and those of subsidiary. Don't include the ones for associate at that point, like for this case. Let's get the total here. When you add, we need now our total equity and liabilities. To get total equity and liabilities, you are going to add. You add 1,531,000 plus 664,000. We shall get 2,200,000 2,195,000. Good. And as we expected, if you are to look at our total asset, remember our balance sheet, we get total asset. Total asset equals to liabilities plus equity. Total asset here, it is there. It is here. Total asset, if you can see this, total asset is there. Total asset is 2,195,000, where we are getting current asset and non-current asset plus current asset to get this figure 2,195,000. But even if we are to go and check our equity and liabilities, still it is the same. We are getting our 2,195,000, meaning our number is balancing. Should not only emphasize at balancing the number, no. The purpose should be to go through the right working, go through the right steps. Don't jump any step. Go step by step. After that, bring the items of non-current asset, current asset, equity, liabilities, you consolidate. As you are consolidating or you combine, we are combining those of a parent and subsidiary. For associate, we only bring this, what we call investment in associate at this step. Investment in associate. We don't include in our balance sheet the financials except only the investment associate, and we have to use what we call equity method and IS 28 as we are accounting for our associate. Yes. Now, this question was a bit big. As we have seen, it has taken us some good time, but if you go step by step, at the end of the day, you will be able to do any number regarding consolidation of any statement. Could be final balance sheet, could be profit or loss, or any statement. But when you are handling consolidated statement of financial position or balance sheet, don't forget these steps. Try to go through as much as you can. You need to know how to determine this group structure, to know with the parent, subsidiary, associate, how much percentage being held in the other company. Then you need to check on net asset. I have showed you how to do that. Check the purchase consideration amount which was paid to acquire shares in another company. Look at goodwill by checking the difference between purchase consideration and net assets at acquisition date. There, it is really very important to know which method to use. If the company has the policy of using full method, use that one. If it is a partial method, use that one. In the examination, they will tell you. If they don't tell you, you can use any method given or you choose. Then step 5, try to determine intra-group transaction. If there is any transaction between members of the same group, please try to adjust. If it is sales, try to eliminate. If it is loans, maybe what could be loan, could be sales purchases, we try to eliminate. We try to determine any unrealized profit on any closing inventory which is still within the members of the same group. We calculate unrealized profit, we adjust on group retained earning, and even it affects the inventory comp in our balance sheet. Try to determine the NCI, this non-controlling interest. Try to determine group retained earnings. Then after, if you have any associate, you try to determine the investment in associate using equity method. After that, then you can be able to come and you consolidate to look at this by putting the rightful format of balance sheet, combine non-current assets for parent and subsidiary, combine the current asset for parent and subsidiary, bring share capital, share premium for parent. Don't add when you reach at this step, you only bring for parent. When I talk of parent, I'm referring at this. Only pick this. Don't add this at this point. Only take for share capital premium, share premium for parent. Then after that, go and bring group retained earning from your workings. After that, you bring NCI already calculated. Try to give a reference. If NCI was working 7, here it is important to put like here, working what? Working 7. It can help the examiner to know where to find that what? that working. If group retained earning was working 8, please you try to put working 8, something like that, so that it can help when it's marking to get reference where you are picking your figures. After that, get total liabilities and equity. It will, if everything is okay, your total asset 2,195,000 will be equal to 2,195 total equity and liabilities. That takes us to the end of this question for preparing consolidated statement of financial position. If along the way there is something you missed or you would wish to know, you want me to come and I talk about it, please just place and your comment section is there the question. I will find it. Any question, any comment, I will come and handle any question regarding consolidation of our financial statement. Don't forget to subscribe, to like videos so that you can always get alerts whenever we put any new video. Please don't forget to share to your friends, among other people. Thank you so much. I remain CPA man. See you again in the next video.